We want to start with Chapter 6, dealing with credits and special taxes. I want to first kind of go over what's the difference between a tax credit and a deduction. There's a difference in how it affects your tax versus your taxable income. You should have a handout that was in your packet of information that says Chapter 6 credits. Credits reduce your tax. Credit reduces your tax. So if my tax is $500 tax and I have a $100 credit, then my tax will be $400. So credits reduce my tax while deductions reduce taxable income. And that's before I get to my taxes. Okay, so the deductions are going to reduce my taxable income. So if I have if I have AGI, for instance, and I get a deduction on my Schedule A, it's going to reduce my taxable income. If I get an adjustment to get to AGI, it's going to reduce my taxable income. So credits reduce the actual tax that you owe, to where deductions reduce the taxable income, which is what you use to come up with your tax. So the benefit for a credit is going to be a 1-for-1 against your tax, and the benefit for a deduction depends on what tax bracket you're in. Depends on what tax bracket you're in. Let's kind of just also do a quick little review of the tax calculation. Remember, we start off with your gross income minus deductions, or total income, minus deductions for AGI, also called above the line. And then that gets you your AGI. And then minus deductions from AGI, and that's going to be your Schedule A. And then that equals your taxable income. So basically, any deductions up to this point, be it a deduction for AGI or deduction from AGI, is going to reduce your taxable income. Those are your deductions. And then at that point, I'm going to get my tax using my taxable income. And then we're going to look in this chapter, tax credits are going to reduce your tax. And that gets you down to the tax that is due. Okay? And then we also have what we call refundable credits versus non-refundable credits. Okay? And what I mean by that, let's say that I had tax of $5,000. And then I had a tax credit of $6,000. Okay? So that means that I would have $1,000. Technically, I have more credit than I do tax. Okay? So if this was a refundable credit, I would get this extra $1,000 refunded to me. So I would get a refund for that. I would get a refund for that. If it is a non-refundable credit, then therefore my credit can only reduce my tax. No refund. So I would not get that extra $1,000. In that instance, it can only reduce my taxes to 0, and I can't get the difference back. So we have refundable and we have non-refundable credits. Majority of our credits are going to be non-refundable. Okay, so we want to start in our book on page 6-1. You have the rest of the handout, in which we're going to use PowerPoint in order for you to complete your handout. And we start off with just kind of talking about reviewing what I just spoke of. Credits against taxes. Credits reduce the tax liability dollar for dollar to where our then we have these refundable credits where we're going to get the excess of the tax liability back to us. We're going to get that excess back to us for our refundable credits. And then we have our non-refundable credits where we're going to get no payment for that excess. Let's look at the tax credits that we have. These are all the non-refundable credits: child independent care, elderly or disabled care, adoption, child tax, education credits we're going to look at, and retirement savings contribution credit. And then the refundable ones in which we do get that excess back, is earned income credit, additional child tax, and then federal tax withholdings and payments. You know, if we have more federal tax withholdings or payments, then even though those technically aren't a credit, but we would get that excess back. Okay, so now we want to start with our child tax credit. We want to start with our child tax credit. This is a $1,000 credit, and you have to have a qualifying child under, and I stress the word under, the age of 17, or one that's permanently and totally disabled. So your 17-year-old will not qualify for this credit. And they have to be claimed as a dependent. I kind of disagree slightly with the credit because at 17-year-olds, they're still in your home. They're still in high school. And that senior year, and to me, when the expenses are quite high, you lose that $1,000 credit. And so it's for under age 17. So it's going to be 16-year-olds and under. So you lose that $1,000 credit technically in their senior year, to me, when the costs are greatest for children. So, but under the age of 17 is the rule. It's going to be phased out for high income taxpayers. It's going to be phased out at $50 for every $1,000 that they're over the AGI. The amounts for high income taxpayers is $110,000 for joint filers and $55,000 for taxpayers filing separately, and then $75,000 for single or head of household. So if you have incomes in those amounts, you would lose some of that credit. Now, a part of the child tax credit is refundable, and it's a calculation that they don't explain in this book. Just know you get a refundable portion up to 15% of the taxpayer's earned income that's in excess of $11,000. So even though you may lose some of the $1,000 because of your high income, you could end up getting some of it back. Or because it's a non-refundable credit, mainly is what the case is, not the income issue, but it's if you lose some of it because you didn't have enough tax, then you could get a portion of it back, refunded back, based on that 15% of the taxpayer's earned income that's in excess of $11,000. So keep that in mind. Next is our earned income credit, our most popular credit that we have. It provides tax relief for lower paid workers and taxpayers with qualifying children who have earned income and AGIs below a certain level, and we will look at what those levels are. And then we have to qualify with no child. You can even get earned income credit if you don't have any dependents or any children. Taxpayer must be over age 25 and under 65. Not be claimed as dependent on someone else's return. And then the qualifying child must meet the relationship, the residency test, and the citizenship test. Married couples must file jointly in order to claim the credit. And it's going to be disqualified for income if you have what they call the disqualifying income over $2,950. If we turn to page 6-2, taxpayers with disqualifying income, and basically this is certain types of investment income exceeding $2,950 are not allowed to claim the credit. Okay, so you have to be careful with your investment. I kind of disagree with that, but of course I'm just a tax teacher. Because to me it discourages you want to encourage low income individuals to save or invest, but here if they have investment income in excess of $2,950, they won't get the credit. They will not get the credit. So just keep that in mind. At the bottom of page 6-2 are income limits. If you have 2 or more children and you don't have income over $38,646, or if you're filing joint $41,646, then you can possibly get an earned income credit. If you have 1 child, as long as you have income under $33,995, or if it's married filing joint, $36,995. If you have no children, if you have income under $12,880, or married filing joint under $15,880, then you could qualify for the earned income credit. Now, the earned income credit is based off your earned income. It's going to be based off your own income. And they have charts in the back of your book. And I often explain the way that the charts work, or the way that earned income is, as far as, you know, who qualifies and for how much earned income. It's kind of on a bell curve type situation. It's like I like to explain it more like on a bell curve when it comes to earned income credit. When it comes to earned income credit, my bell curve is not all that great. And this represents your earned income. Okay, so if we have learned a low earned income and then we max out, remember we're going to max out at a certain amount. And so basically over here, for instance, would be my $38,646 for 2 children or more. So if I'm over that, I'm not going to get any. Okay, but what happens is, as I have income, say, of 0, for instance, if I had income, I'm looking at the chart, let's give you an example of 750 to 800, and I have 2 or more children, then I would get an earned income credit of like $310. So not that much. But then as my income goes up, I get more of an earned income credit. For instance, if my income is, let's pick a number, 8,000. If my income is 8,000, then my earned income from 2 children is $3,190. So it keeps, the more money I make, the more my earned income credit. So as I keep making more and more earned income, it keeps going up. Then at some point in time, it's going to plateau. And then it's going to start coming down. And let me see if I can find that amount for you. And I'm just looking at my charts. It keeps going up. It goes all the way up to actually $4,143. Nope, it's still going up. No, then it becomes down. So at 19,000, like about halfway through, if you have earned income of 19,000, you can get an earned income credit of $4,143 if you have 2 or more children. Then it begins to go down. On this side of it, let's say I have earned income of $22,000. Then I'm only going to get a credit of $3,500. So what happens is that as my earned income increases, I get more and more earned income credit. But then at, like in this case, 19,000, I get the max that I can get. Then as I begin to make more than that, the amount of earned income credit that I get goes down as I make more money. So because that gets very confusing to people, and they get very frustrated because they say, wow, you know, when I earned $19,000, I got a huge earned income credit, but as I made more money, I got less. So I try to explain to them it's a bell curve situation, that, you know, at some point in time you plateau out, and then after that, the more you make, the less of the earned income credit that you get, Okay. Also, for earned income credit, you can receive advance payments. If I'm an individual and every year I know I get $2,000 of earned income credit, I can, through my employer, be able to receive that earned income throughout the year. I don't have to wait till the end of the year in order to receive my earned income credit. If I decide to get this advance payment of my credit, I must file a tax return, because I have to file the tax return to state or show that I did qualify for it. And then it's included on my W-2. My employer would include it on my W-2. So you can get it in advance. You do not have to wait to the end of the year to do so. Okay, let's move to our next credit for child independent care. This is for care for a qualifying child, and you can get a credit of those expenses anywhere from 20 to 35% of the expenses. From 20 to 35%. If you have income of $0 to $15,000, then your credit is going to be 35% of your expenses. And of course, the more your income, the less percentage. And if you have $43,000 or more, then yours is going to be 20% of the qualifying expenses. This qualifying person must live with you for more than half the year, be a child that's under age 13, or one that's claimed as a dependent. If they're not under age 13, then it has to be someone who's dependent, who's physically or mentally unable to care for themselves. Or it could be a spouse who's physically or mentally unable to care for themselves. So, or it could be another dependent that you're claiming, a parent or whatever the case may be, who is physically or mentally unable to care for themselves. Okay? The expenses that are deductible, the expenses that I can deduct, are expenses for payments of in-home and out-of-home care. So if they go to daycare or they go to a facility, payments for household services such as cooking and housekeeping, that could be included in there if it relates to that child. The cost to provide protection and care. It does not include now payments to a taxpayer's child that's under age 19. If you have a child, your 18-year-old who's caring for your 3- and 4-year-old, and you pay them, you cannot deduct those expenses. And then if you have a child care reimbursement account, which is a situation where you can take out $5,000 pre-tax for child care. So your employer would take it out pre-tax before it's even taxed, and then you would use that $5,000 to pay for your child care. So that's a huge benefit. If you're in a high tax bracket, then you get that $5,000 taken out before it's taxed at 28%. The issue is that, let's say that I have $6,000 worth of expenses, child care expenses, and I got $5,000 reimbursed. So I have to take my $6,000 of expenses minus that $5,000 that I got to reimburse. So the only child care credit expenses that would qualify would be the excess, would be the $1,000. And that's a huge benefit, because that $1,000, because of whatever reason, I may only get 20% of that. I know I'm not going to get more than 35%. So it's a better benefit if your job provides that to where you can take it out pre-tax, and it's child care reimbursement. Okay, so it must be reduced by that. Okay, now there's some limitations on the expenses, so you have to be careful with your expenses too. It's $3,000 for one qualifying child, and $6,000 for 2 or more. So if you have 10 children, the max you can get is $6,000. It's also going to be limited to earned income of the lower income spouse. And then if you have a spouse that works, and then you have a spouse that's a student that has no income, opposed to it being limited to 0 because you have the spouse that has no income, then that student is going to be deemed to have earned income for $250 per month for one child, or $500 per month for 2 children. Okay? So I want to point out a couple of things in the book before we get going, move further with that. On page 6-4, it tells us that if this child that you're referring to, that I want to take child care credit for, if the child parents are divorced, and then that child need not be a dependent of the taxpayer claiming the credit. So it may be a situation that I can't claim the credit this year, my spouse can, but I pay it. I can't claim the child, It's my spouse's year to claim the child. I can still take the child care credit. But the stipulation is that the child must have lived with the parent for more than half the year. They give you, for example, a mother who, with custody of a child, may be entitled to a credit even though the child is a dependent of the father. So keep that in mind. Let's look at the example on page 6-5. We have 2. We have Harry and Molly Grant are married and file a joint return. They have one child and they pay $4,000 of child care expenses during the year. Harry earns $16,000 and Molly earns $8,500 during the year. Okay, resulting in gross income of $24,500. Okay, so given that $24,500, you look at the chart, they would end up getting 30% of their amount. They pay $4,000, but remember they only have one child, so they're limited to $3,000. So you would take the $3,000 times 30%, and so they would get a $900 credit. $900 credit. Let's assume that, for instance, we have Harry and Molly. They have $4,000 of expenses, but Molly is a full-time student. She's a full-time student, so she has no income. In that instance, she is going to be deemed to have income for $250 per year, because where this comes into play is that the qualifying child care expenses are going to be limited to the lower income taxpayer's salary, okay, or income. So long as their income is not over, as long as they have enough income, then there's no limitation that we have to deal with. So let's kind of look at, I'm just going to make up this example just so you can see it. We have Harry and Molly. Remember, Harry had $16,000 and Molly is a student. Let's say Molly is a student 9 months out of the year, so she's going to be deemed to have $250 worth of salary because they only have one child. So then we're going to treat her as having salary of $2,250. They pay $4,000 in expenses. Okay, we know she can't get more than $3,000 for one child, but the issue is it's going to be limited to the lower income taxpayer's income. So in that case, they would only get qualifying expenses of $2,250, and so you would use that as her income plus Harry's to determine what percent they would qualify. So when you have a full-time, and you have to be full-time when you have a full-time student, then they deem them to have income. They deem them as having income. Okay, so that is our child independent care, where you have those limitations. You have those limitations, so you want to watch those limitations. Okay, let's look at our higher education credits. We have a higher education credits. We want to start with the Hope Scholarship credit. The first one, this particular credit is $1,800 per student. And the way you get the credit, you just don't get the $1,800. The credit is 100% of the first $1,200 and 50% of the second $1,200. So in order to get the $1,800 deduction, you have to have at least $2,400 worth of expenses. If you have more than that, the most you're going to get is $1,800. If you have less than that, then you won't get the $1,800. So it's based off 100% of the first $1,200 and 50% of the next $1,200. For the Hope credit, the person who qualifies for this is someone who's enrolled in the first 2 years of post-secondary education. So this is somebody within the first 2 years of their education, and they're at least part-time or half-time doing one semester or one quarter. So they're at least part-time doing one semester or one quarter. And they pay tuition, and what we refer for tuition is basically qualifying tuition and related expenses incurred by the student pursuing the degree or vocation. It does not include room and board and books costs. So we're really looking at tuition and expenses here. And then it's not available to students convicted, let's just say convicted of, convicted of a federal or state drug felony. So if you've been convicted of a federal or a state drug felony, you cannot get the Hope credit, which to me is a little contradictory to the name of the credit. I believe the Hope credit is for those in their first 2 years to give them hope or encouragement to finish, but not if you have a conviction. You can't use that credit. You can go to school and do all those things you need to do, but you can't take a deduction for that credit. So in that case, you would not be able to take a deduction for the credit. let's look at the top of page 6-6, and let's look at the example. Jenny graduates from high school on June 2008. In the fall, she enrolls for 12 units at Big State University. Big State University considers students who take 12 or more units a full-time student. Jenny's father pays her tuition and fees of $1,700, so she pays $1,700 that year. So they would get a Hope credit of 100% of the first $1,200, which would be $600, and then 50% of the second amount. Wait a minute, 100%. I'm sorry. Whew. They paid tuition and fees $1,700. We'd get 100% of the first $1,200, which is $1,200, and then when we get 50% of anything after that, in that case, it would be 50% of $500. So the credit that would be able to take is $1,450. So 100% of the first $1,200, 50% of the second $1,200. Okay. Next, we want to look at the timing of the expenses. They say, long as they're for qualifying expenses that are paid in a year in which you're going to start school at least, they say, 3 months after the start of the year. So let's say I pay for spring tuition in December of 2008. That semester is not going to start until January or February of 2009. I get to take that deduction in 2008, even though the expenses were incurred technically in 2009. So they tell you that if the actual academic period begins during the first 3 months of the following year, then you can deduct it in the year of payment. Okay, now we want to look at our other education credit, which is the Lifetime Learning Credit. The Lifetime Learning Credit. This is a $2,000 credit per year, okay? And then it's 20% of the lesser of $10,000 are qualified tuition costs. So basically the maximum cost that you can take on this is going to be up to $10,000 worth of expenses, and then you're going to take 20% of that. So therefore that gets you to the $2,000. This credit is for, you can take it for yourself, your spouse, or any dependents, okay? Yourself, your spouse, or any dependent. It can be for the student, can be, don't have to be part-time. They don't have to be within the first year. They can be undergrad, graduate, or professional courses are eligible. All those are eligible to take it. So it's a lifetime learning credit. You can be half-time, full-time, take one course. So you have a lot of options here as far as being able to take this credit. So look at page 6-6 and let's look at the example they have here. In September of 2008, Scott pays $1,200 to take a course to improve his job skills to qualify for a new position at work. His lifetime learning credit would be 20% of that $1,200 or $240. So you can take it for undergrad, graduate, professional, one course, job skills course. So excellent credit, 20% of the cost, up to $10,000 of cost or $2,000 of credit. Now this credit does phase out for high income taxpayers. It's going to phase out for taxpayers of if you're filing a joint return between $96,000 and $116,000, and if you are not joint, it's going to be $48,500 to $58,000. So high income taxpayers are not going to be able to get that. So you're going to have to get a portion of those expenses. You end up with a portion of those expenses. If you are a high income taxpayer, you're going to only end up with a portion of those. Let's look at the example on page 6-6. We have Jason, who's a single father, has AGI of $52,000 in 2008. In 2008, he pays $5,000 in qualified tuition for his son, who just started at Party On University. Without any limitations, Jason would be entitled to a maximum Hope credit of $1,800, which would be 100% of the first $1,200, 50% of the second $1,200 for his son's expenses. Now, he was single, and he had income of $52,000. So remember, our range for someone single was $48,000 to $58,000. So he had, his fell in between there. So therefore, he is going to be limited to some of his, the amount of credit he can take. So what we want to do is take his $52,000 minus the $48,000, his amount minus the upper limit, and we get $4,000. Okay, and then we want to divide it by 10,000. We want to divide it by 10,000, and we get to 10,000 from the range between 48 and 58 is 10,000. Okay, we get 40%. He had an eligible credit before any reductions of $1,800, so therefore he's going to only end up getting $720 of the credit. The married filing jointly range is $96,000 to $116,000. So that gap is $20,000. So when you do this calculation up here for joint, the bottom number is going to be $20,000. So keep that in mind. So it's going to be phased out for high income taxpayers. It's going to be phased out for high income taxpayers. Okay. Okay, there's some other limitations and things that we want to look at the bottom of page 6-6. Married taxpayers who don't file a joint return can't get it. As I already said, it's not for room and board and books. It's just for tuition. Expenses paid for non-academic fees or for expenses that aren't related to the student course or instructions, like to get in basketball games and things like that, would not be included. Qualified educational expenses must be reduced by any tax-free scholarships or employer reimbursements received. Also, the credits cannot be used for expenses that are deducted from taxable income on tax returns, like unreimbursed job related education expenses, meaning if I'm taking it somewhere else, I can't also take a credit for it. And then important students claimed as dependents of other taxpayers are not eligible for the education credit. The persons who claim the student as a dependent can claim the credit. So the person who's claimed the student as a dependent claims the credit. So even if the child pays the expenses, but if they don't claim themselves as a dependent and the parents do, the parents can get the credit. Even if they didn't pay the expenses, the parent can still get the credit. Let's look at the top of page 6-9. Brenda's a college student who works part-time and pays part of her college expenses. Her parents pay the rest. Although Brenda files her own tax return, her parents claim her as a dependent on their tax return. Brenda cannot claim the credit for the qualified amounts she paid, but her parents can claim the credit for both expenses they paid and the expenses that Brenda paid. The other example, we have Gary, a college student, works part-time and pays part of his college expenses. His parents pay the rest. His parents have high income and would not be able to claim an education credit for Gary. Now, if Gary's parents decide not to claim Gary as a dependent, even though he qualifies as a dependent, Gary can claim an education credit on his own tax return for the expenses he paid and also for the expenses his parents paid. Since Gary could have been claimed as a dependent by his parents, he is not allowed to claim a dependency exemption on his own return. So even though his parents don't claim the dependency exemption, he didn't qualify to claim it. But because the parents didn't claim him as a dependent on their return, and even though he's not technically claiming himself as a dependent, he can still claim those education credits. He can still claim the education credits. Okay? It's important to know that you cannot, if you look at the top of page 6-9, you cannot take both credits for the same student in the same year. So I can't take a Hope credit for my freshman and a lifetime learning credit. And then both credits can be used for different students in the same year. So you can't take it on the same student in the same year. Okay. Next, we want to look at foreign tax credit. Okay. A credit on income earned in foreign countries, and they're subject to income taxes. They're going to be subject to income taxes in that country. So let's say if I'm working in a foreign country and I'm going to have to pay income tax on it, I then can take a foreign tax credit for those taxes that I have to pay. basically the calculation is there. It's the net foreign income divided by the U.S. taxable income, and then you multiply it times your U.S. tax. Okay. Any unused amount of this credit can be carried back for 2 years and carried forward for 5 years. Now, you can either take this foreign tax credit, or you can take a deduction for foreign taxes. So remember, you can take it as a credit. It directly offsets your taxes, or you can take it as a deduction for foreign taxes. So you have that option to take it either way. You can take it either way. Okay, let's look at and you have to fill out form 1116. Fill out form 1116. Let's look at the top of page 610. Taxpayer Z has net income of $20,000 from country K, which imposes a 15% tax, and $30,000 from country L, which imposes a 50% tax. His taxable income in 2008 from U.S. sources was $80,000. So he had $80,000 from U.S., $20,000 from country K, and $30,000 for country L. So he had $130,000 worth of income. It says in his U.S. tax liability before this credit is $35,000. So we would take his net foreign income, which is $50,000, divided by his U.S. taxable income, which would be all of it, $130,000. Then we would multiply it times $35,000, and he would get $13,462 credit. The foreign tax credit is going to be the lesser of that $13,462 or the actual foreign taxes paid. His actual foreign taxes paid was $18,000, so therefore he's going to get a credit of the lesser of the two, $13,462. So that's foreign taxes. So you go through the calculation and you determine, okay, this is what my foreign tax credit would be. I compare it to my actual foreign taxes, and the actual credit is going to be the smaller of the two. Okay. The last credit that I want to cover is the adoption credit. You can get a credit for qualified adoption expenses. These are all reasonable and necessary adoption expenses, court costs and attorney fees. And it's going to be reduced by any reimbursement your employer may provide you. Some employers provide some reimbursement for adoption expenses. That adoption credit is going to be taken in the year that the expenses are paid, if the adoption becomes final in that year, and we'll look at some examples. If not, then it's going to be allowed in the following year. Okay. For foreign adoptions, no matter how much expenses and have spread over how many years, that credit is going to be taken in the year that the adoption becomes final. You're limited to the first $11,650. It's going to be phased out for high income tax it's going to be phased out for high income taxpayers. And if you are adopting a special needs child, you get the full credit is allowed. If I'm adopting a special needs child and I only pay $5,000 worth of expenses, I get the full $11,650, despite I didn't pay that full amount. So in that case, you get to take the full amount. Let's look at a couple of examples or read that to determine that year. When does it become final? Okay, on page 611, we got Ben and Beverly. They paid $4,500 of qualified adoption expenses in 2008 to adopt a qualifying child. Their AGI is $180,000, so it's high, which causes their credit is going to be reduced based on that phase out. So they wouldn't get the full $4,500. And you can look in your book and look at those calculations. Another example. In connection with the adoption of an eligible child who is a U.S. citizen and is not a child with special needs, a taxpayer pays $6,000 of qualified expenses in 2008, $6,500 of qualified adoption expenses in 2009. The adoption is not finalized until 2010. So we had some expenses in 2008, 2009, and finally it's finalized in 2010. The $6,000 of the expenses paid in 2008 would be allowed in 2009. So since 2008 wasn't the year that the adoption was final, then you take it in the next year. That's where that, if not, then you take it in the following year. Would be allowed in 2009. The $5,650 of the $6,500 paid or incurred in 2009 would be allowed once again in the following year, in 2010. Okay, and in that example, in that first year they had $6,500. In the second year they had $6,500. That would make them have $12,000. Actually $13,000. They can't get the $13,000. Remember, they're limited to the first $11,650. So in that second year they would only get $5,650. Now, on the other hand, if the adoption were finalized in 2009, then they would take the full $11,650 in that year. Okay. Now, foreign ones are different. In 2008 and 2009, a taxpayer pays $3,000 and $6,000 respectively for adoption expenses in connection with the adoption of an eligible child who is not a U.S. citizen. In 2010, the year the adoption becomes final, then the taxpayer pays an additional $3,000 of qualified expenses. The taxpayer may claim the $11,650 credit in 2010, the year the adoption becomes final. So, if for some reason on a foreign adoption, if the adoption does not become final, then there's no credit. So that's why they make you wait until the adoption becomes final in order to take that credit. And then any unused amounts of that credit can be carried over up to 5 years. So if you have some unused amount of that credit, it can be carried up to 5 years. On page 6-12, they kind of go over the adoption expenses and also how to coordinate a credit in the exclusion and then employer-provided adoption expenses. So do take some time to look through that. Okay, we'll stop here and then we will pick up on temporary energy credits and perhaps finish the credit chapter in the next segment. So make sure you're reading through that chapter and completing those multiple choices at the end of the chapter. That's it.